And then they put a new infrastructure, which is FedNow, around this electronic payment system. And they're going to do what Nigeria and China did. They're eventually going to roll out this natural central bank digital currency. The pilots in China and Nigeria weren't met with a lot of success, but what the state is doing is forcing the people to accept it. So the digital currency era is here. Africa's largest economy, everybody's being forced into it, literally forced into it. There are riots in the streets, there are people complaining, but they have to use it. And in China, they're going to force it as well.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Robert Kientz from GoldSilverPros. Rob, thank you so much for joining us today.
Hey Elijah, thanks for having me back on.
Well, it's great to have you. I would like to discuss first the metals markets. It seems like we've been seeing gold and silver pop really ever since the banking crisis started. Now gold is above 2,000 and holding that pretty well, and silver is touching 25. I think the ask right now is above 25 as we record. So your perspective on that?
Yeah, they popped, and it was good news. I think I was kind of expecting that to happen because of the bank failures. You had Signature Bank and SVB, and you had one called Silvergate, and then First Republic, and then we saw Credit Suisse. And really, mostly in the United States, most around tech and crypto sector, but also Credit Suisse was a bit of a different animal because it was really more of a broad commercial-based bank that had its fingers in everything, over in Europe. And so I think we saw that there are banking problems in multiple places, and I think a lot of it had to do with what happened with the debt. The debt in society is used as what we call a high-quality liquid asset or a high-quality asset on the books. And that's what all the Basel III requirements are that comes out of the BIS. And so you have all these requirements for liquidity. Banks are holding liquidity they're supposed to be holding. They're holding high-quality liquid assets. But what happens to the quality of those high-quality liquid assets when interest rates rise? Well, bond values have to go down. That's just the nature of the way that bonds work. The price moves inverse to the interest rate, and then you calculate your yield. Well, the yield goes down when you have a rising interest rate environment on existing bonds because that coupon or that interest rate does not change. And so you now have, let's say rates go up to 6%, you have a 4% rate bond, your bond's worthless because you're only paying 4%. So if you go out into the secondary market and try to sell it to your neighbor across the street, he's going to say, well, if I buy a new one, I can get 6%. I'm giving up 2% interest, so let me pay you a little bit less. And so that's what happened to the banks. And so as interest rates went up, the debt that they were holding that's an asset in accounting terms went down in value, and it caused them to have basically they weren't meeting like capital and liquidity requirements that basically come out from Basel and from the banking regulators. And so anyway, that caused a run on the banks because people panicked. They said, oh no, if you don't have enough assets, we could have an issue with the bank. They took the deposits out, which actually was what crashed the banks. It was depositors taking the money out, which is what crashed them and caused the banks not to have enough liquidity. And so the banking system, Elijah, is essentially this big Ponzi where you have a small percentage of the overall money sitting in the bank as deposits can be used, for daily operations of the bank, and then the rest of it's lent out, and that's done in more speculative assets. And then to cover the bases, if they need short-term money, they do things like go to the repo market and go to other short-term markets like money markets. In a nutshell, that's basically what happened. You just saw a crash of that system because asset valuations came down. And I expect we'll see more of that. I mean, certainly there's only so many high-quality liquid assets that are defined that banks can hold to meet their capital and liquidity requirements. And you have things like stock of other banks and companies. You have debt. You have gold. You have cash, and then what else is there? Most everything else is not considered high quality. So when those high quality liquid assets come down in value, that's what caused the banks to crash. So that's kind of where we are. It's interesting to note that both Signature Bank and SVB, Silicon Valley, have the competitors to the FedNow system. They had Signet and SEN. So now it's questionable whether or not those alternative payment systems, private payment systems, will be available. It looks like FedNow will have a monopoly now on that for U.S. bank accounts. So it certainly works out for the central bank. Didn't work out so much for people that held money in the banks. And I don't think just a last bit here. I don't think we're out of the woods yet on the banking crisis. I think we're going to see more because the fundamentals haven't changed. But at least now we have an idea what the playbook may be by the government for when something like this happens.
When it comes to the FedNow service, do you see this banking crisis kind of being an excuse in some sense to roll out this new service? And it seems like FedNow is kind of a alternative to the digital dollar. So can you expand on what the FedNow service actually is, and is it a good thing, or should people be a little bit concerned about it?
Yeah, so FedNow is essentially direct digital payments between account holders. It can be business to business, it could be business to consumer, consumer to consumer. So think about if you're using Cash App or Zelle or PayPal. What the Fed is trying to do is for all participating banks in the Fed system, which is most of the U.S. banking market, they essentially want to create electronic payments between bank accounts. I love the idea. I mean, how many times has it been frustrating when you need to send somebody money, a friend cash, and Cash App doesn't work, or they don't have Venmo, or for some reason you can't send the PayPal, or you have all these exorbitant fees. When you look at FedNow, it's very appealing because the fees are low, like a private crypto, and that's why I think the system is built. In fact, I know it's built on blockchain. And I'm researching FedNow. I've been researching for a while. They're not telling us the blockchain they're using, but I know it's blockchain. One, because of the fees are at the level that only you can get with the blockchain. It's a lot cheaper than the average everyday fee, which is a good thing for account holders. But also, if you look at the way they've set it up and the way that they're going to move to the digital dollar, they need that ledger system to be a digital ledger. So, and there are documents on the FedNow's website which lead me to believe it is a very popular blockchain ledger. I don't know which one. I'm sure somebody out there knows. Just email me and let me know, and I'll do the research. But it's a blockchain-based thing, and what it does is allows payments. So if somebody wanted to pay you directly in your bank account, they can. But Elijah, that also infers that it would allow withdrawals, because if you can put money in, can't you take it out? And what are the rules around that going to be? And it seems like this is the progenitor or the original version of what is going to be the digital dollar. This is the infrastructure being laid for the actual digital dollar token, which will be rolled out later. And to answer your earlier question, yes, I think they're rolling this out because everybody knows the existing system's dead. I mean, they know it's dead. It's dead. They've been keeping it on life support since 2008, since the Great Recession. They know they needed something else. Everything that they've come out with it since then, the QE and the massive money printing, was to save the system, to put something new in place. They came out with new regulations in the form of Basel III and now 4, I think, which is going to be coming. And then they put a new infrastructure, which is FedNow, around this electronic payment system. And they're going to do what Nigeria and China did. They're eventually going to roll out this natural central bank digital currency. The pilots in China and Nigeria weren't met with a lot of success. But what the state is doing is forcing the people to accept it. So the digital currency era is here. Africa's largest economy, everybody's being forced into it, literally forced into it. There are riots in the streets, there are people complaining, but they have to use it. And in China, they're going to force it as well. I don't know whether they're going to force it in Europe and the United States, but I imagine, to long answer your question, but I imagine when that crisis comes, you never let a crisis go to waste. If we have a crisis in the confidence of the dollar, which I think we're having right now, and what's going to get worse with de-dollarization, yes, they're going to need a replacement. And I think it's convenient because I think the financial climate is going to hit everybody at once. I think it's going to be worldwide. And so why doesn't the whole world just kind of move into this new system? And I think that's what the BIS, the IMF, and the world central banks want. It's easier for them to move into this system. And I will say there are some benefits. Being able to pay people directly, through the system without having to use third parties is going to be extremely convenient. The problem is all the stuff that comes along with that. Are we going to go to the Chinese social credit score? I've been also reading on China's social credit score tied to their digital currency and their digital payments. And it doesn't look so hot. And we have politicians here in the United States that are actively saying we need to roll out something similar. So it's not just the digital payments that we're concerned with and will that system work. It's what they can tag on to it. And if they get a social credit system in place, you're not going to have your Bill of Rights. You're not going to have your freedoms, because if they control the money, they control you. And that's the fear that a lot of people have. And we don't know what that's going to look like, but that's the fear that a lot of people have, is we don't want a centralized system controlled by the central bank.
No, it's kind of hard to see how the FedNow system, if it's just a payment system, how that would really solve any of the issues in the banking system. Sure, it'll make things faster, probably add a bit of control and lack of privacy there and all of that. But does it really solve any of the systemic issues in the banking system that really caused SVB and Signature to go under?
Well, in a way, yes, because it's not really solving a problem as much as it's replacing the old problem with a new one. And so it's going to look like it solves a problem because the old problem is conveniently going to go away. And what's that old problem? The old problem is debt. And the old problem is we have debt. We want to spend more than we have. And what has been the thing that has caused all currencies in time to fail? It's rampant printing. Think about the currencies we had previously in the U.S. that were printed during the Civil War and busted and caused, financial calamity. Think about all the currencies have been printed across the world that have busted. Zimbabwe dollars, Argentinian pesos. We've had tons of examples. Even the UK pound stopped being the world's dominant reserve currency after Bretton Woods, and that shifted over to the United States and the dollar. So the bond system and the fiat currencies and the ability to pull consumption forward to the present and spend more than what we have is a system which always was going to crack, and they knew it. Silvio Giselli, an Italian, hopefully I'm saying his name correctly, Italian economist in like the late 1800s wrote about it. John Maynard Keynes knew about it. Irving Fisher knew about it. They wrote about it. Got to get rid of debt. They just didn't have a mechanism, Elisha, for getting rid of debt because you have cash and you have debt. That's the system. It's a physical system. Well, now they want to move to a digital system. And so in the writings of those guys, especially Silvio, they said they need to get rid of the debt system. And if you get rid of debt, essentially you don't need the retail banking system. If you have both a regional electronic currency, which can be controlled in the central banking system, which it can be, and the FedNow is at the center of it, the central bank controlling, you now have a hub and spoke. And the hub and spoke doesn't necessarily need a bunch of regional banks. You can do it with fewer commercial banks. And so that would, I think the regional banks are going to go away. You're starting to see them come under stress now. They're the ones which, if you notice the government's response to the regional bank failures, they let them fail and they just made the depositors whole because they didn't want bank runs to bankrupt the system. They're not ready for that. But they didn't go make the bondholders and the shareholders whole. So I think they're going to let the regional banks fail. I think the system will be controlled through the commercial banks, the big ones, the JP Morgans, HSBCs, and Bank of America's. And it will, and I think they're going to go to perpetual debt. In other words, they're going to get rid of any end-dated debt that they need to pay with coupon payments and all that stuff. They're going to move debt into more of an anachronistic thing, which eventually will go away, and eventually they'll get rid of cash. And that's a process. And if you look at the IMF paper, it takes about a generation to handle. So they'll roll out the digital currencies. They'll begin to get rid of the debt-based system. And then the final piece are the bail-in laws that came about as a result of Dodd-Frank and some other legislation, which basically says, when they get this digital system in place, they can push button bail-in using depositors to make the banks whole. And so the bail-in laws would then come into play. And that's ultimately where they would take money out of someone's bank account. The last thing that's part of this system and that people aren't talking about as much, but which is very important, is they have a discount mechanism or they have a negative interest rate system on the bank account. The IMF wrote a paper on this. So this is an official IMF research paper that's turned into a policy in which the central banks have agreed to, which is when you get into electronic money, when someone gets money deposited in their account, $100, they may only give you 95 electronic dollars. Well, they've just taken 5% out of the system. That's called a bail-in. Okay, or that's called negative interest rate. So they've reduced the amount of money in circulation, which gives them aggregate control of the money supply and helps them control inflation. But they've also bailed in using your bank account. Well, with the FedNow system, the new laws, and all the electronic components being put in place, this is now possible. It wasn't physically possible before, but now it is. And so then, because FedNow is on blockchain, all they got to do is layer on top the coin or the digital dollar, and that's the final piece. And I suspect that they'll do that when the existing paper dollar comes under pressure. They've already been designing it, and they'll roll that out last. But the way that they're doing it, if you look at the IMF and the BIS's papers, they're doing it through the banking system. So they're making structural and fundamental changes to the banking system that people aren't going to notice every day, and they're going to run the system through the banks, but they're going to run it through the big regional banks. That's the plan, essentially, on paper.
So what do people do is the big question. It seems like so much more control over people's financial lives this could lead to. What are the action steps that people need to do, or what are some things that they need to consider right now?
That's an interesting thing because think about it from an individual perspective or a business perspective. I'm also a small business owner. I have to pay employees. So how do I do that if we have issues in the banking system or issues with cash? And so there are a lot of things to consider. It's not only, you being able to buy groceries. It's if you're an employee, are you going to get paid? If you have employees, you're going to be able to pay your employees. or you can be able to pay for things like car repair. I mean, it gets really complex trying to figure out if the banking system goes through issues and we have bank holidays and we go to electronic money, can I live the existing life that I have now? Can I live to the level that I live now? And if they control, essentially through the system could control what I purchase or how much I have to purchase things, are essentially controlling, my commerce. So I could see a lot of people saying, well, I don't necessarily want to be in that system. And then what are the alternatives? Well, when they get rid of they get rid of options through traditional banking, you got to go unbanked. And so you've got your private cryptocurrencies, you've got gold and silver, you've got bartering services. I mean, that's the kind of thing that people are talking about doing. And if you look at what happened in terms of availability of cash in both Nigeria, well, we'll just focus on Nigeria. When Nigeria rolled it out, they said 45 naira a day in cash, which is nothing in terms of, dollar value, 200 a week. Nigeria said, we're not putting 85% of the cash back into the system. We're only going to let 15% of cash circulate in new nodes, and the rest went electronic. And so people only had a very little bit amount of money of cash that they could transact, and everything else is controlled by the bank, and it was controlled as to what they could do. Now, all they had to do in Nigeria is roll out a social credit system, and you've got control of the economy. You've got 100% control of the economy. I'm not sure if they're going to do that in Nigeria, but that's the potential. So you got to go unbanked, and it's gold and silver is the main way. And then if you have any cash and people will take it. And then outside of that, it may be electronic payment systems like a Kinesis or a Load Coin or something in which you have metal stored and you can use a debit card, assuming you can do that. So those are alternatives. But I suspect people, we may go back to where we're using gold and silver as money. I suspect that's what's going to happen. A lot of the states are removing taxes from gold and silver, kind of essentially making it legal tender. Some are officially making it legal tender. Some are just removing taxes off of it to allow it to circulate as money. And I think in those states, you'll see the free exchange of gold and silver as money. In other states, I don't know. Maybe we develop black markets or gray markets for things. I'm not sure what's going to happen.
Obviously, they can have their funds outside of the system by holding physical precious metals, but like you said, I think it's going to be a really tough road ahead, because if you're a business owner, you have to pay employees, you have to use the system. Everyone has bills they have to pay. They have to stay in the system in some way. So it seems like maybe kind of a dual model, or people have to kind of live in both worlds at the same time going forward.
Yeah, I think that's exactly what it's going to be. You're going to have your officially sanctioned monetary system, and then you're going to have the system that people put in place to actually cope and live. Because if the state sanctioned system doesn't allow for either enough money or enough freedom for people to transact, to live on an everyday basis, they're going to create their own systems. And I think gold and silver are going to become front and center for that reason. Any sort of commodity, money, wood, anything of value that you can trade, your skills, your expertise, your time, I think will come, to the forefront. And I think that there will be I'm already seeing in the market alternative systems developed to trade gold and silver on alternative exchanges and to facilitate maybe more private pathways for gold and silver to be money. Of course, on the crypto side, there's been a lot of the U.S. government cracking down on the cryptos, the on and off ramps. If you're going to attack the on and off ramps to the banking system, then what you've done with the cryptos is you've created a self-contained system that can't connect to the existing system. So if you think about that, if you have to be in the existing system, but you need an alternative system, you can use a private crypto for that, but they're removing the connectors. So what you would have to do is find some way to get your crypto into cash outside the banking system and then bring it to the banking system. And so what they're doing is if they make that difficult, it makes it harder for us to have alternative systems. So I right now, it's easier to make life harder for Bitcoin people because you have an electronic component and you have the banking on and off road ramps, and they can affect both of those. With gold, silver, once you have it, you don't need a banking on and off ramp necessarily because it is money. And if you already have it, then you don't have to worry as much about new laws that they put into place around ownership and things like that, assuming you're not going to ban it, which I don't think that they will. I don't think they're going to ban gold and silver. So I think that's what it's going to look like. I think there's going to be very gray markets for money. I suspect that there will be some underground money markets and things that are developed. And I think there would be a very robust gold and silver market that develops. People that have been smart and have bought even fractional silver, like junk silver or constitutional silver, which is coined money prior to 1965, or have some of the old gold coins or fractional gold, I think are going to do very well because, regardless of whether you individually choose to put 100% of your commerce through an alternative system, there are going to be enough other people to do it that are going to need liquidity. So if you have gold and silver, you just in a way became the bank for other people that need gold and silver. And so now you may be like a little mini bank providing liquidity to people to trade. And I think it's going to become very prevalent. But I also think people are going to have to use the system, especially people with jobs. If you have a job and you work for someone else, you got no choice. And so we're all going to have to live to learn in that system. But it's how we transact outside that system, I think, which is going to be a true measure of how much freedom we really have.
Now, when it comes to the short term, I did want to discuss the economy and what is happening right now. We're seeing jobs and labor numbers coming out. What is your outlook kind of on the short term and also the impact these will have on metals prices?
Yeah, part of the reason that Silicon Valley Bank crashed is because tech is crashing. And layoffs are up nearly fivefold so far this year, with tech leading the way, according to CNBC. And we just have had so many layoffs. And not only that, but the persistent unemployed numbers, people filing more than a few months, has gone up. And so a lot of the labor numbers are starting to turn over and not look so hot. The labor force participation rate, which is the rawest number, it's just how many people can work and how many people are, has been down dating back to the last financial crisis. And it last peaked around 2000. So about 23 years ago, we had the highest percentage of people that could and wanted to work were working. And then for a period of time, we had a labor force in which there were a lot of people who couldn't work, but we had enough people working, so it worked. We could afford to pay social services. Now we're getting the labor market starting to get stretched and start to crash, especially in tech. I think there were 89,703 layoffs for the period, which is up 15% from February. And it's not just in tech, it'll come to other areas. Real estate, I think commercial real estate definitely is going to be one. But I think the layoffs are starting. And it's because companies' costs are going up of lending, sales are down, retail sales are down. And this is going to be something that spirals, because if consumers are 72% of the economy and retail sales are down, and therefore companies don't have enough revenue, and then they got to lay off, and then those layoff people can't spend, it's going to keep going this way for a while until you get to that break-even point at which you've laid off enough labor slack in the economy, that the businesses can start to grow again and lending costs come down. And right now, lending costs are high and layoffs are just starting. So I think we're entering a period in which employment's going to become a really big issue, and it's going to put a big strain on the economy. And I think that's ultimately what's going to stick us in a recession. And if you look at the White House's response to the last recession call last year, 2 consecutive quarters of negative GDP, the White House said, no, we still got employment, because they're saying, well, the consumers are still there. It can't be a recession, which is not typically how we call it. But you could see the argument. Well, now that argument's starting to fall away because labor's starting to have issues, and it's starting to be sticky. And so I expect this Friday, when we get the non-farm payrolls or the BLS government payroll report, it's not going to look good. The ADP that came out yesterday on Wednesday did not look good. The other statistics on continuing claims don't look good. The statistic on capacity utilization rate, how much we're working, the labor that's working is utilizing, is down. So the entire economy is down. And the reason it's down is because we lack that demand. This is a demand-driven issue, demand-driven deflation. And that's where we are. And so labor's got to come down. It's going to cause issues as well, with companies and earnings reports. And we're about to just head into recession. It's normal recession stuff. We're headed into it. And we're going to start seeing, those headlines going forward.
And with precious metals popping right now, do you anticipate them having a pullback here when we get that news, or a continued run up from here?
I think we've seen a little bit of pullback's not the right word, just a little bit of softness. And that happens when you have a big move. Rare do you see gold go up more than 2% consecutive days or even in the same week. Usually, if it goes up a lot, it'll come back down. It may even sideways trade for a while. And that is because the nature of the market's derivative. It's paper. So it's a lot of paper trading doing that. It's not necessarily indicative of the physical demand. It's indicative of the paper. And the paper's trying to do, what most of the paper does in gold is they're looking for a few pennies on a contract, and they'll roll a bunch of contracts. So they're really trying to gauge what everybody else is doing. So it is the true marketplace of what's going on, but it's the future risk in gold. And so that the spot price reflects the market's anticipated future risk price for gold going forward in paper terms. So I expect that there'll be some weakness. that people are like, yeah, I'm not going on that next leg until I see that momentum. And it appears as though that people are going to think we're behind it on the banking thing. We handle the banking thing. Depositors are made whole. There's some losses, but the economy's not crashing. But I think the news is going to keep coming. And when the next big batch of news comes, I think gold pops up again. But I think it'll drift a little bit here until we either have another bank failure or something really pops in one of the big markets. We continue to see bad earnings reports or labor reports. That'll continue to kind of push it up. But the next big boost in gold is going to come from the next big crash, crypto crash, bank crash, that type of thing. Maybe a company comes out and says, a big company like an IBM or an Apple, and they come out and say, ooh, we lost a bunch of money. Something like that could cause it to pop. So I think that's what's going to happen. I think it'll range trade here for a little while. Gold will hover somewhere around 1,900 to 2,000. Silver will be at 23 to 25. And then if we don't hit another big negative economic announcement, they'll come down because, again, it's just the futures trading. They're trading on what everybody else is going to be doing in 2 to 3 months. So it's just perception of what could happen in 2 to 3 months, not necessarily a measure of risk. And that's what people need to understand about the gold spot price. It's not a measure of risk because it's determined by paper trading. It's a measure of where people think the price is going to move in the next couple of months, guesstimating what the economic news is going to look like. So when that economic news is bad, that gold price will pop. When it's okay, it tends to range trade. And when it's good, gold price comes down. That's the pattern. I suspect more bad stuff's going to happen. It's going to go up, but it's not going to be linear. It's not a straight line on the gold and silver markets. It tends to burst. You have bad news, burst up, drift down. Bad news, burst up, drift down. And I think that's the pattern that we'll have until, something big happens. Either we resume a growth path and the economy is okay, or whether it crashes. I think it's going to be the crash. And that's, what I wrote the book about and why I started GoldSilverPros.
All right. Well, Robert, thank you so much for your time today. Where can our viewers find you online if they would like to learn more?
Simply go to GoldSilverPros.com or find GoldSilverPros on your popular social media, Twitter, TikTok, and YouTube.
Fantastic. Rob, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.